Continuing our series on stamp duty land tax, let's take a look at commercial property, albeit briefly. When it comes to commercial property in the UK, you all need to be aware of VAT, even though this video is on SDLT. And I promise SDLT will play a role in this. But first, let's look at the key aspects and implications associated with VAT on commercial properties. Now, you're thinking of buying a commercial property and have been advised when you're looking to buy it through the agent that the seller has opted to tax and therefore they are going to charge you VAT on the sale proceeds. You might think that being charged VAT on your property transaction will not be problematic and then you can just fully reclaim all the VAT back, and you might be right. However, this is not the end of the whole story, because your SDLT that you pay, it will be payable on the purchase price plus the VAT element. So you're paying the SDLT on the additional 20% VAT element too. For example, if you were to buy a commercial property for £1 million plus VAT, i.e. £1.2 million total consideration, you'll pay £49,500 in stamp duty land tax compared to £39,500 if there was no VAT on that particular transaction, saving you a grand total of £10,000, a significant figure for most of us. The other problem obviously is the cash flow challenge, because you've then got to find the VAT funds and you then have to file a VAT return, then you've got to try to get the money back from HMRC, and then if you borrow the money from a bank, you're paying interest and other costs with that. If you don't get it back in time, the banks usually give you 3 or 4 months to get the money back, sometimes 5 months. So if you need to get it done within that period, otherwise you'll have a problem. Now, there is a situation where you could request the seller to revoke the option to tax by filing a VAT 1614D notification form. It's up to the seller whether they accept it or not, but you can try and make that a part of the negotiation when you're agreeing to buy the property. And this basically says it's your intention to convert from commercial to residential, and therefore the seller agrees not to charge you VAT. The key date for the seller with the 20-year rule is when they opted to tax the property with HMRC, not the date that they purchased it. And the 20-year rule basically is when you opt to tax, you run it for 20 years. If you come out, there may be some VAT implications in terms of paying VAT back to HMRC. The sale or lease of a commercial property is typically exempt from VAT, relieving a purchaser or tenant from paying VAT. However, commercial property owners retain the option to charge VAT at the standard rate of 20%. During property sales or leases. When a landlord or vendor or seller opts to tax property, then to charge you VAT on those supplies, which means they're charging VAT on the rent, and then also they are charging VAT when they sell that particular property, unless they've had it for 20 years and then after 20 years they can revoke the option to tax. Landlords, however, cannot recover VAT because rent is an exempt supply. Therefore, any VAT that they incur is a cost to the business, and you can't be registered for VAT for that particular purpose. Certain property transactions are subject to standard rate VAT, including the supply of new commercial freeholds that are less than 3 years old, and other commercial properties if the option to tax has been applied. Conversely, zero-rated supplies are applicable under certain circumstances, such as the onward supply of newly built properties for residential or charitable purposes. Transactions that do not fall under the standard rate or the zero rate supply or categories include the grant of interest or licenses in land and are generally exempt from VAT. But you could register land and opt to tax that as well if you wanted to. Opting to tax a property can have implications, and it requires charging VAT on all rated supplies, but it also enables you to recover VAT that you've incurred in terms of your associated costs. Revoking an option to tax is subject to certain conditions, the significant being repayment of any input tax deducted as a result of making an option to tax, where no interest has been held for 6 years from the date of the option to tax. The option to tax can be revoked after 20 years from the first date of opting to tax. While this is a positive overall, a landlord or buyer cannot recover VAT on all rated costs. What happens if you have a tenant in situ? If you buy a non-residential property with a tenant in place, so you're not buying it as a vacant possession, then you need to explore the transfer of going concern rules and see if they apply to your particular transaction. If they do in this particular case, when you buy a property, you won't have to pay VAT when you complete on the transaction. In other words, you're basically buying a rental property business, and you're not buying a property with vacant possession, and therefore there's a transfer taking place, so you don't pay VAT on the purchase. Now for this to apply, you have to register for VAT going forward, and then you also have to opt to tax, so then you're in the system for the next 20 years. But it saves you paying the VAT, finding the cash to fund the VAT, then making the reclaim, and all the stuff that's involved, which I covered for you earlier. A partly tenanted building can still qualify as a transfer going concern as long as the rental income is substantial enough to be classed as an economic activity. For example, let's say we have a property owned by VJ, and Barry is the tenant in that particular property, and VJ wants to sell the property, and we have Katie who wants to buy the commercial property from the landlord, but there's a lease in place, so Barry will still remain a tenant. VAT won't be charged on that particular transaction if there's an option to tax, because Barry remains part of the property going forward, and then Katie doesn't pay VAT in the rent, but she has to register for VAT going forward and has to start a new option to tax for her particular transaction and her commercial property. Now what if you're converting? So if you plan to convert a building from commercial to residential, like I said earlier, you can issue a form VAT 1614D to a seller, asking them to override the option to tax election, so that their property sale will then not have VAT on it. You have to issue that particular form before contracts are exchanged, so this is important. I'd say try and make it part of the heads of terms, so when you're negotiating the price, tell them there'll be a VAT 1614D and make that part of the negotiation. The reason this works is because residential property does not have VAT on it because it's an exempt supply, like I shared with you earlier, because there's no VAT on rent. Now in conclusion, you've got to understand the intricacies to some extent, or be aware of the intricacies of VAT on commercial property in the UK for both buyers and sellers. And while the standard rate of VAT is commonly applied to specific instances, exemptions and opportunity tax provisions can significantly impact the financial dynamic of a particular property transaction. So even though this whole series was on SDLT, VAT plays an important part in this, especially because you've got to pay SDLT on the VAT element too. So being aware of VAT is important. Remember, not all commercial properties have VAT on them. So always ask the question, is there an option to tax in place? And the agent, if the seller has an agent, will be able to confirm that to you. So I know there's a lot here and I've covered it briefly. Any question on VAT, comments below, more than happy to answer. If you find the video useful, let me know by clicking like, and if you want to be updated with new videos, click subscribe and you'll be notified when a new video comes online.